So I think without further ado, if everybody is on, Chris, if I could ask you to bring on the panelists. We have 3 speakers for this session. We have Ketan Patel, who is from EdenTree Investment Managers, who specialise in this area. Again, hugely experienced, wonderful that he can join us to talk on social issues. Miranda from Aegon, fantastic that Miranda has also been doing engagement in this area for a long time. And then Victoria, also from Aberdeen Standard. Again, loads of activity going on there across a huge range of companies. So lots of different types of expertise and different issues that people can talk to. So can I just check, are you with me?
Hi, yes.
Fantastic. Ketan,
Yep.
You're quite low down in the screen, Ketan. You might, if you can angle something, but we're all good. The joy of working on Zoom, eh?
Indeed.
Well, that is perfect. Well, I'm very pleased that you're here, especially after a lunch break. It's always slightly risky. Thank you so much for joining me. This panel is, to my mind, so important, and it's so now. And there's only 3 fund managers presenting on this one, by the way, because we've got 16 fund manager partners on Fund EcoMarket, but only 15 wanted to speak. So this just happens to be the one we've got 3 on. But the session will be, I'm sure, hugely interesting, different views, lots of enthusiasm for actually driving this agenda forwards. So can I please then start off by asking you to all introduce yourselves. Ketan, would you like to start?
I can. Hi, my name is Ketan Patel. I'm a fund manager at EdenTree Investment Management. Been with the firm for just over 17 years. In terms of what I run, in terms of money, we are, as you know, a leading responsible and sustainable investment house. I run a UK screen fund as well as a global equity income, which is also screened, which is specifically for charity clients.
Thank you. Miranda, would you like to talk about what you do?
Yes, my name is Miranda Beacham. I am a Senior Responsible Investment Manager at Aegon Asset Management. I've been in the company for 25 years. I co-founded the Responsible Investment team in Edinburgh 20 years ago. So I've been right through the kind of evolution of ESG, ethical, responsible investing. We have 2 funds that are particularly pertinent to this panel. We've got our ethical, which is the screened fund, which screens out kind of the worst offending sectors, and we've also got our global sustainable equity fund, which is really looking for sustainable solutions to problems that are facing the planet these days.
Thank you, brilliant. And Victoria, would you like to describe what you do, please? Introduce yourself.
Hi, I'm Victoria, and I am an investment director on the global equity team at Aberdeen Standard Investments. Been with the firm for 10 years now, almost to the day. And we run a number of sustainable strategies. So I'm responsible for the global equity sustainable strategies, but we also have sort of regional based strategies as well as a climate environment fund. And it's really become a core part of what we're doing. And ESG is integrated across the process, regardless of whether the funds are ESG designated or not.
Okay, lovely, thank you. So the question I put to you, which obviously the attendees, I keep forgetting attendees won't have seen, is diversity and equality. What can, and then in brackets, and can't investors do? Because obviously there are some things that actually, logically an investor is in a really good position to do, and there are other things that frankly, however much we might want to change something, actually we can't. We're just not in a position to do that. Obviously, that's where other factors come into play, maybe regulation or consumers. But can I start by asking you, maybe Ketan and Victoria, to say how you define social issues? What do you consider to be social issues? And to comment on the premise of the question, which is really that diversity and equality are actually relevant to investors. They've been overlooked for so long. So are they relevant? Ketan, would you like to start?
I'll go first. Thank you. It's a good question to ask. For us at EdenTree, we've been doing this since 1988, so we've got a long history. And the fund, which is founded by Sue Round, who's still on the fund as well. So the S in ESG has really come to the forefront during the pandemic. The ideas of social justice and social inequality is now full and center at the political agenda. And investors are now being challenged because of the pandemic. We've had probably a period of global inequality now, which has now come right to the forefront, and the pandemic has accelerated a lot of issues here. So diversity and equality have always been part of the core pillars of the EdenTree screening process. And often the E is often seen as a really, really kind of sexy part because it's easy to measure. It gets a lot of political kind of viewings, but the S and the G don't. And G is a real pivot, is actually engaging with the companies and say, what difference can you make in the communities in which you operate? Also in terms of how they manage a workforce, their whole supply chain, etc. And if that's driven well, the benefits should accrue to the S, which ultimately is where you want to see the benefits accrue to.
Lovely, thank you. Yep, definitely. If people aren't benefiting, kind of, well, not what's the point? Obviously, we look after animals too, but yes, people have got to benefit from all of this. Victoria, would you like to come in and answer that question? So,
yeah, I mean, I think that point about people benefiting is really important, and I think one of the easy parts to criticise about the S is it comes from the sort of shareholder primacy lobby that says, it's just about profits, and I think that really is fundamentally incorrect. Not just wrong from an ethical point of view, but it's fundamentally incorrect. I think financial markets operate within society, not outside of it, and I think my own personal view is that thinking about the social issues is not incompatible with the idea of focusing or thinking about shareholders. But even if you were to take that view, I think the way that it's framed as profits first is actually a very narrow interpretation of, firstly, corporate law, because it's not necessarily true that profits is synonymous with shareholder interest. So it's a very narrow definition from that point. And I think it's also fundamentally flawed from an economic point of view as well, because it sort of assumes that markets are perfect and therefore profit will be the outcome if you do exactly what markets want. And I think what has become very obvious, first in the climate issue, but also in the social issue, is that this is a real problem of negative externalities and market failures. So market solutions aren't, or sort of markets left to their own devices is not the right solution and doesn't lead to the best economic outcome. So I think there's a strong economic argument for this, as well as the sort of moral part of it. And I think if you look at who's making these arguments, it's the people who are incentivized to do so because they're the ones that are benefiting. It's a very narrow part of the shareholder population who are the 1%. And so if you think about it, they are the ones who, of course, they're going to say this because it's in their interests for it not to be more fairly spread and for these issues not to be thought about. But I don't think that's necessarily, there are other shareholders in the world. So GPIF, for example, one of the biggest pension funds, is representing people who are 20 or 30. And so what they care about is very different from, say, an executive who is also a shareholder. So it's not, in my view, incompatible. And I think there's a further element which is often ignored, which is the justified return element. So, even someone who was thinking about shareholder primacy wouldn't be okay with making excess profits out of extortion or bribery or illegal behavior. And I think we need to broaden our concept of what is a fair and reasonable return to think about, we shouldn't be making excess returns that exploit people or resources. And I think that's currently what we're doing. And we, for some reason, view that as acceptable. And I think that's where we need to adjust our viewpoint as well.
Yeah, I think that's absolutely right. I think a small minority of very vocal people have been very selective with their quotes they've chosen from the likes of Adam Smith and everyone else over the years, just picking and choosing what suits them, which I think you're absolutely right. I think we're coming to a time where we're all getting a bit smarter to that and realizing that can't be allowed to carry on. At least I really hope we do. So moving on, sorry, Miranda, would you like to add anything onto that? So relevance, diversity and equality, the relevance to investors.
I think, being kind of careful about diversity and equality and also how you look after your employees just makes economic good sense anyway. Because if you've got a fully engaged workforce, then you're more likely to be a successful company and you'll be able to weather storms a lot easier.
I think that's a really, really excellent point. Thank you. Yes, keep your staff on board. Absolutely. So then my next question then, Miranda, I'm going to point this your direction to start with, but Victoria and Ketan, if you'd like to come in afterwards, please do. So what do you look for? What are the warning signs when you're looking at companies that have got good and bad practices in this area? So if a company's not up to scratch, what are the red flags? What do you notice? And can you give any examples maybe of voting or research or things that you've done as a result, Miranda?
Yeah, I mean, I think you can always start with kind of controversies, what's being said in the press, what the ratings agencies are saying, but that's a very, very kind of low baseline of where you start to look at these kind of things. But you really have to kind of understand the culture of the company. So you need to scratch beneath that surface, you need to look through their reports. And ultimately, you actually need to engage with the company, both at an executive and a non-executive level, to try and get to the culture of the organisation, to see how they deal with these kind of issues at board level. You know, for example, we've been engaging as a house for the past 3 years on diversity with the chairs of these companies from a responsible investment point of view. But our fund managers are also engaging with the executives and asking questions about, you know, what does the diversity look like in these organisations? Where would they like to be? How are they going to get there? And who is ultimately responsible for it? So I think it's very important that you thoroughly engage with companies to really understand what is sitting beneath the surface, because a lot of the larger companies that have got a huge budget will be able to talk a good game, but you really need to understand if there's anything behind that.
Absolutely. And it's really interesting to hear you talking about engagement also, because obviously your company, I've known them obviously from being Scott Eck way back when, better known for strict negative screening, but you're talking about a lot of engagement stuff here. Do you want to give a size of the magnitude of what you do on that side? And I'll ask the other two to come in on that as well.
Yeah, so our ethical fund, which has obviously been going for 30 odd years, is a negatively screened fund, and it will take out, you know, the worst offenders, but that is taken out by a screening process. When we look at our overall ESG integration in all our funds, even the ones that aren't, you know, ESG kind of flagged, we take engagement very seriously. So, for instance, last year, my team engaged with over 400 companies on a variety of topics. But one of our biggest topics was the whole diversity and inclusion topic.
That's fantastic. Thank you. Ketan, did you want to come in on that one at all?
Yeah, I mean, I guess in terms of signs you're looking for different companies, there are certain sectors which always have the usual suspects, the same companies or the same process, etc. And a good example is fast fashion. You know, they've asked it further down in terms of engagement. So, you know, Boohoo's been in the press over the last, 6 months probably. And the scandal is obviously unwinding. It floated in 2014. We looked at it and it failed the E, S and the G at that time, and it still continues to do so as well. There is no independent chair. It's run by a founder who's dominant, etc. And you've seen the stuff that's happened in Leicester. Now, when you talk about diversity and equality, the workforce in Leicester primarily is Asian women from a brown, Asian, Bangladeshi, Indian, Pakistani community, the most vulnerable. And this has been happening in Leicester for a very, very long time. You know, it's nothing new. And it's interesting how now that none of the largest auditors want to audit this company now. So even auditors are now understanding the reputational risk. You do not want to be associated with a company with poor practices.
I think it's all obviously going from bad to worse there, isn't it? And it's
it is, and it's been going on for decades and decades, and it's just been it's been an open secret. And there was, I mean, the worst part for us as an industry in terms of S&G, 20 funds were invested in Boohoo, and some still are invested. Some have taken the brave choice to divest, so well done on that. But the ones who are still exploiting those women. So how do you define the economics of a pair of jeans for £4 or T-shirt for £2? Who's making money on that? No, that those women who are working in those poor factories on less minimum wage, quasi-slavery conditions, those are the ones. So every time anyone who walks in and buys something from Boohoo, etc., acknowledge the fact that that is coming from the most oppressive, conditions.
So do you think then, coming through to the next question as well, linked to that, obviously George Floyd's death and then Black Lives Matter and everything that happened this summer that, regularly had lumps coming to my throat now, but had a lot of us in tears.
Yeah.
Are people recognizing that stuff more? Do you think that's changed the way investors feel about things? I mean, Ketan, carry on by all means on that for a bit, and then I'll move to the others.
Well, yeah, just briefly. I mean, that because it was, on your TV in the 1980s when Nike were behaving badly in Southeast Asia, that rarely came out. There was issues of Tesco's in farms in South Africa, but because now we live in a social media age, it came out straight away. So it can't be hidden away, can't be brushed away. Management have to deal with this stuff in a very open manner as well. And in many ways, it's not when it's how companies react, management, when things go wrong. Things will always go wrong in life. It's just how they react to it. And the whole George Floyd movement in particular has said there is a part of our community that we have failed, whether it's from political, economic, social, etc. And so this is our chance to make it right by using the levers of capital, as Victoria said earlier. We can make a difference, but it's whether we choose to do so now, and we as investors can drive shareholders' capital and tell to management, you are here to represent us, the client, the shareholder, the owners, and not yourself just to maximize profit at any cost.
Absolutely. Miranda, would you like to pick up on that at all?
Yeah, I think as an industry, we're not terribly good at it. I think one only had to look at the Reddington survey that was published on Monday to show that investment managers are quite slow in picking up the fact that diversity in general is a good thing for business, and that needs to be part of the investment decision-making process. So there's a long way for us to go, but we need to start somewhere. And I think, now is the time that we need to start. We need to start thinking about how we put this into our decision-making policies, and also how we deal with it internally. Famously, investment management is a kind of pale, male and stale kind of industry. So I know as a house, Aegon Asset Management are trying their best to support, some initiatives to try and resolve that, but it's not a short-term fix. We're looking at helping girls in schools through Future Asset, but also Social Mobility Foundation, and trying to get the pipeline building for the future so that we will be able to rectify this.
Lovely, thank you. And Victoria?
I think that point on sort of looking internally is really important, because I think, it would be wrong of us to sort of demand diversity from boards and within companies, and not a credible request if they can turn around and say, well, what about you? What do you look like? And the industry looks worse than a lot of the companies that we're criticizing. And my personal view is I think that we need to be bolder in what we're asking for. And I think, the 30% club was a great start, but, women are 50% of the population. And so, that is how they should be represented. And I think a lot of companies are making a lot of efforts at the pipeline in the early talent stages. And I worry that that's not going to solve the problem further up, because it's not a problem that gets fixed with time. I think people need to acknowledge that we need to take more proactive steps and, really look at doing more sort of bolder moves, sort of have a candidate, make sure every job has a candidate list that's 50-50. So I spoke to a company yesterday where for all their decision makers, that will be a requirement that the candidate the candidate sheet of interviewees has to be 50-50, and it should be the same across sort of any type of diversity question, whether that's gender or ethnicity, across the board. And I think we just really need to stop being lazy and relying on, oh well, we don't have the talent. And I think it was Wells Fargo CEO who came under quite a lot of criticism for saying, oh, we just don't have enough sort of black talent as an option. And I think that's just a galling thing to say. And I find when people say the same thing from a female perspective, I look around my company, around other businesses, there are plenty of people who are capable of doing these jobs, but because there's a perception of what skills or what experience you require, and I think we equate experience with skills too often because it's something that we can judge that's tangible. And I think we really need to think about what we're asking of people in the job spec, in the way that we interview, in the questions that we're asking, and really criticize the interviewees, not just the list of people that we're getting, but it is actually, you're allowed to choose somebody based on their minority status if between two candidates they are both equally suited to the task from a merit point of view, if you identify diversity as something that you need to address. So you are actually allowed to make these decisions. And I think education and sort of getting people over that hurdle is really, really important, because I don't think it will be fixed with time, and I don't think it will be fixed with low hurdle targets. And I would like to see the industry push for more than 30% or sort of, one or two representatives of a minority on a board. Like, I just don't think that's good enough.
Yeah, I completely agree with that. My only concern and my reason why I've not been terribly active in the whole 30% Club Women in Business and all that area is because I just look at the number of ethnic minorities that don't even get a look in. I find it slightly uncomfortable that, middle-class white women like myself are somehow being prioritised over all these, young lads from different ethnic backgrounds. So I don't need their help. I will fight. But those guys, they're not even get their foot in the door. So I really struggle with the different dynamics on that kind of stuff.
And I think a part of it is listening as well. You know, we've got all these internal networks, but they tend to be they represent the group, but you're not getting, you know, senior leadership along to those meetings necessarily, where it's outside that they need to be accessing. And I think it's our responsibility, you know, as the majority to listen and to go and hear those concerns, because I think people don't even believe almost until they've heard someone's story that minority status has affected someone, and like the very specific ways it does. And the only way you do that is to listen to people and listen to their stories and how it's worked for them. And I think we pretend it's not an issue because we don't listen.
We also don't gather statistics is the problem. You know, it's very hard to manage something that you haven't measured. So while the statistics are not there to prove it, it's going to be very difficult to resolve.
It makes it invisible. Ketan, any more comments on that?
Yeah, I was going to say, I mean, it must be a bit more difficult for larger companies like Aegon and Aberdeen, certainly the EdenTree. I've been quite fortunate when I joined the firm. Sue Round is there, she still is, was CEO, now is interim CIO. In terms of, you know, we've got 8 fund managers at EdenTree, and 25%, myself and my colleague David Katimba-Magwana are from a Bain background. 50% of the analyst team is from a Bain background. And once Neville finishes his recruitment later this year, 75% of the RI team will be women from not just different cultures, but from different countries as well. Maybe for a smaller firm, you know, in terms of stats, we can make a huge difference. So it shows, and maybe the fact that the whole business has been led by a woman since 1988 and was progressive then and is still today, that has shown if the leadership of a organization is progressive enough and intelligent enough to take people from different backgrounds as well. I mean, Sue famously said, you know, I don't really care where you went to university. In fact, I don't even care if you went to university. All I care is about your experiences and what you can bring within a team structure. So when we are talking, when we want to recruit, we don't go to the usual same places. You know, we want to go far out and also go out and reach out into the community and give people who don't want to go to university a start in the industry as well, and let them grow and bring their experience to the actual table as well. So I'm lucky enough, I can speak from an extraordinary position of strength thanks to Sue's hard work. And it has made a huge difference having colleagues from other countries come into what we're seeing as a very sleepy English insurance company's asset manager. We're now seen as a leading player within ESG, and it's been driven by women like Sue. You know, and it's very rare to get women in charge of asset managers. It's only recently we've had, a couple of years ago, we had Carol Galley and Mercury. Then we've got Anne Richards now as well. And I think it's really important that it comes from the top, that tone. Yes,
I think, I mean, leadership is a massive thing. And, you know, until we get more women leading business, I think, yes, it's hard to see it changing particularly swiftly. Can I then come on to the next question here, which is more about supply chains? So can you tell me, maybe Miranda starting off, with regard to supply chains generally, how do you go about ensuring or looking at whether or not a company's supply chain is decent, if they're paying their staff properly and treating them fairly, and really what role can investors play in that?
Well, again, it goes back to kind of looking at what's said publicly. So you can rely on kind of NGOs such as the ETI and Ethical Consumer, who will have done a lot of investigating as to, you know, who's the best and who's the worst in the market. But again, I go back to engagement. You know, for example, you know, in fast fashion, then we did think about investing in one of the companies, but there was a bit of a smell around the company at the time back in 2018. And we reached out to the company and we never got comfortable with what that company response was. So we decided to invest elsewhere.
Generally across the board?
Pardon me?
Generally across the board, across all of your assets in the fund or wider beyond? What is there stuff in your regular processes that weed out those worst companies? Or?
No, I mean, I think you can kind of slightly kind of screen out, you look at particular industries which are vulnerable to supply chain issues. So and you can kind of help, yeah, you can get kind of red flags through the kind of screening process and through these NGOs. But before investing, then generally we will have a conversation, you know, because there is actually another company that we've invested in, a homewares company, where they are excellent at explaining exactly how they go about surprise audits in their supply chain, what they do when a problem arises, what actions they take, how much time they give them to rectify that, and how far up the organisation. And that company in particular actually had one of the former chief executives absolutely loved doing that kind of auditing work and going out and really understanding the nitty-gritty of the supply chain of that. And actually going on, that gentleman is no longer the chief executive. However, during the COVID crisis, they have proved themselves to be absolutely exemplary in dealing with their small suppliers. And that helps, the way they deal with the suppliers helps the way that the suppliers then deal with their own employees.
That's
so
really
again, it goes back to engagement and really understanding the companies that we're investing in.
Yeah, that's really good to hear. I mean, obviously the bad companies always make the headlines, and rightly so. They need to be outed for rubbish stuff that they're doing. But it's good to hear there's some really good examples. And you can say, yes, there's companies here that we think are benefiting because of their good practices. Ketan, I'm sure you have some opinions on this also.
Yeah, I mean, for us, we've got a negative screen, like the guys at Aegon as well, but also a positive screen around 6 core pillars, and 2 of them are business ethics and employment and labour. So we see about 700 companies a year, well, that we did in 2019, less so in 2020, thanks to COVID. And there, we have an integrated process, so the analyst or the FM goes and asks those difficult questions. And we also want to highlight positive cases as well. If you look at a company like Tesco, years ago when it had hypermarkets outside Shanghai, it insisted that the UK practices would be adhered to in China, including the right to form a union, which that we take for granted, but in China and certain parts of the US, you try forming a union at Walmart, it's not going to happen. So what Tesco did was take the same rights, whether it's paternal rights or maternal rights, etc. A break every 4 hours, sick pay, all that. But they went one step further. They're told, if you want to be part of our local supply chain, you have to adhere to those rules. So they're lifting the benchmark for local companies to partner up with Tesco. And that's a really good example of a very large company. And the company that Miranda was talking about, we also invest in as well. It's been family owned, it's now public, but that ownership structure has meant that there has been a pastoral or a paternal nature to how they run their business. So there are great examples out there. There's some awful ones. Anything that's low margin and relies on volume, and a good example would be G4S. Scandal to scandal, because the margins are so wafer thin. Mighty, Capita, Serco. These are usual suspects when it comes to abuses of what I call supply chain and also treating people poorly. So there are easy ones to pick out to avoid. And I think for us as a house, it's about picking the best quality ones and also championing them as well. Say, thank you, you are doing the right thing, because often management don't get thanked for doing the right thing.
Yep, thank you. Yes, indeed. And thank you. So I'm going to come on to the next question now. We've got about 5 minutes before I need to wrap up. So if I can just ask, starting with Victoria, please. Obviously you run different funds, so this is quite a big question for your group, which is good because you can pull different levers in different ways and at different times, but you've got engagement and divestment and positive investment. Can you talk us through a little bit where you sit on the spectrum there and how you use the different levers to help in the context of social issues?
Yeah, so I think it sort of depends on 2 things. Part of it is the expectation or the purpose of the client. So, like the sort of religious type client or charity clients, they will often have quite clear ideas from an ethical point of view of things that they just will not invest in. And, that's something that you have to take into account. The way that we look at it from not a divestment, but from a not investing perspective, is that we, for the new sustainable strategies, we do apply screens, but we've tried to step away from a purely sort of moral or ethical standpoint and really think about it from the perspective of risk. So risk and harm. So tobacco would be an example where, we're not looking at smokers and saying smoking is bad, smoking is terrible. You're saying tobacco has a very clear and objectively measured harm that you can kind of quantify. The company is 100% exposed to creating that harm, and its revenues are at risk because the world is trying to tackle that harm. And so that company will find it quite difficult to diversify away from that risk or moderate that risk. And so you have a huge amount of ESG risk from that company, which, as much as you engage, they're not necessarily going to be able to do anything about that for a certain point of time. Having said that, I think tobacco is also a really interesting segment of the market, which I think investors have still not maybe got their heads around in terms of how to think about how these changing businesses should be considered. and I'm thinking there of the example of Philip Morris, would come out with a very clear corporate purpose, which is to become a smoke-free company. And that will obviously be a transition, and there are questions you always will have to ask about the credibility of that, given their track record, of their marketing practices and the lobbying in the background. You first want to make sure that's a credible aim, and you want to make sure that the targets, which are quite high and ambitious that they've set themselves, are something that they can achieve. But they are arguably in the best position to have the biggest positive impact in terms of reducing that harm, because regulation alone has not been able to fully address it. So I think there's a role for investors as part of that conversation. I think understanding the impact and the consequences of those kind of things is something where the industry is maybe not quite mature enough yet, because it's a big challenge. And I think the integrated oil companies will be the same. At some point, they'll get to a transition phase where if they meet their targets, they will be investable in ESG portfolios. And at some point you have to say, okay, well, if we know that now, there is a point at which they will become investable, and how do we identify that point? And is it going to be too late from an investment purpose to get there afterwards? So I think those transition ones are a challenge that we need to think about conceptually. I think divestment does have a role, and I think again with the integrated oil, that's an example where clearly from the share price moves, there have been more sellers than buyers. And I think part of that has been linked to people's assessment of the long-term opportunity of the business, and whether they link it explicitly in their minds to ESG or not is clearly partly driven by environmental risk and the increasing cost of abatement, the risk of stranded assets, and these businesses literally being worth negative, not just zero. And so divestment has played a role in that. But I think the challenge is, when do you walk away? When are you able as an investment house to make that difference? And I think in public equities, the idea of additionality and what are we doing is still difficult to sort of define. And I think engagement is one of the key areas where that is possible. And I think divestment ties into that as well, is that you need to set yourself set the company clear targets of what you're looking to achieve with engagement. It's not just saying, we will vote for this, we won't vote for this. You need to set the company targets, and you need to say, this is what we want to see from a change perspective, and be willing to walk away if the company aren't achieving that. And I think there's a lot around, and it came up in the supply chain discussion, data, verifiable evidence, and how we actually track what is happening is an area where in the social side of things is more difficult, particularly in supply chains. And I think there needs to be an improvement in that. And I also think there needs to be an education around interconnectedness of some of these issues. The fair energy transition is an example where you could move to renewable energy all in one go, and that would have quite significant social consequences as well, in terms of jobs, in terms of what that means for developing markets. And so each decision on one issue will have knock-on impacts on another, and some of those might be positive, but some of them might be so negative that they outweigh what you're trying to achieve there. So understanding the nuances and the interconnectedness of it. I think
you're absolutely right. Yeah, sorry, I'm going to cut you in because we've got one. Sorry, completely agree. I'm being given notes here saying that we're about to run over. I completely agree with everything you've just said. Can I ask you then, each of the three of you, to just sum up and make some closing remarks, but also while you're doing that, touch on what do you think is going to happen over the coming months and years, but please do keep it sharp. We're meant to have finished just now. So Miranda, can I come to you first, please?
Yeah, I think there's two things that it's going to become a bigger conversation. I'm quite happy that it's moving out of the responsible investment realm to talk about diversity and inclusion and into kind of mainstream, helping our vendor management team, helping our RFP team, helping our investment managers to have these conversations with the companies that they deal with. Makes me very happy.
Yeah.
And secondly, having conversations with the companies is getting easier, as these companies are getting used to having to justify what it means to their company, what diversity and inclusion is going to mean for their profitability going forward, means that this is a much more fruitful exercise now.
Brilliant, thank you. And Ketan, can I ask you if you have?
Yeah, I do. I'll say, I just hope that we're not having this conversation in 5, 10, 15 or 20 years.
Oh, don't. Yeah, I completely agree. Absolutely. Hopefully we've kind of had a wake-up call this summer. I wouldn't like to guarantee that we have, but I like to think that we've moved a step closer to sorting out this kind of stuff. I want to thank you all very much for your time. I know this is a difficult subject. Can I please ask you if you've got any information on this that you'd like us to put onto Fund EcoMarket, do send anything across. I've created an area on there to put reports and information. This is so high profile. When I send out newsletters, I will link people through to materials that have been sent. So anything you want to say on that, please make me aware.